Dipen Sheth, Head Institutional Research at HDFC Securities, joins us. Dipen, I can't believe when we last had such a conference. I mean, I've almost forgotten how it looked in 2006 and 7 when there was a lot of money coming in. But we didn't have the reform piece at that time. It wasn't as if the government was doing much. Now everything is falling in place. So do you think that by March we are going to look at, a 5-digit number for the Nifty?
I'm happy you haven't specified March 15 or 16.
Which March, okay.
Yeah, so, but we are going to be marching there in any case, if I can take a few liberties. The thing is, you've hit it bang on the head when you say that we've got a confluence of positives here. Almost everything that was or used to be wrong with India is now getting right. And that's exactly where we are turning super constructive on investing in this country at this point of time. So markets are different, but they'll run up ahead of reality for a while and then correct or consolidate, and then you might have some bad news and you get a chance to buy and so on. But it's very clear that this is a multi-year, multi-theme, multifaceted bull market in the making. And it's driven on the back of an economy which is substantially and structurally changing. So there will be market factors and ups and downs along the way, but the journey and the direction are very clear at this point of time. And this conviction is grounded in the fact, and we put it in our somewhat 2071 note on around Diwali, that the two big things that are wrong with India, that used to be wrong with India, were its excessive dependence on a commodity which had shot through the roof, which is oil. About 80% at last count of oil requirements are imported into the country, not to mention gas. And the fact that for a variety of reasons, we never had a government or a governance structure or a set of policies which were encouraging of business. And on both counts, these are the two big monstrous things that were wrong with India. And both these monsters now seem to be gradually getting under control. So there's no reason you shouldn't be bullish on India. And I really don't care that QE will stop in the US or there will be a structural breakdown or panic in Europe and so on. India deserves capital now. It's not just that a rising tide is coming and will lift all boats all the way from India to Peru to Mongolia to Brazil to Venezuela or whatever it is. We deserve capital. We are a huge country. We are 1,250 million people getting our act together. And there's no way that the serious investors anywhere in the world are going to lose track of this.
Okay. Dipen, hi, morning. I'm very interested in the Diwali picks that you have put out for us in a note. So let me start off with two of the themes that will benefit the most from the recovery, the domestic recovery, financials and industrials. What are your top picks there?
It's interesting, Sonia, that even in these 26, as many as 26 odd picks, we jokingly refer to them as special chabbis in the office. But even in these, there are some 7, 8 odd stocks which we don't even cover, and this is part of the big picture on change happening in the country, which will drive stocks and businesses which are out of the radar into your buy zone, simply because there is meaningful transformation happening in these businesses and the environments in which they work. So specifically on financials, for example, we decided to put SKS Microfinance in the list. We don't even have formal coverage on it, but a cursory look tells you that this can be. So they've gone through a horrifying period in the last 2 years in terms of the crisis that blew up at Andhra Pradesh and now Telangana also. And it's the ex-Andhra Pradesh book which is now in spick and span shape. They've got high spreads, high return ratios. They're adequately capitalized. I think they raised 450 crores. They're still trading very costly in terms of, their book size is roughly their market cap, which sounds silly. But remember that this book size offers multiple years of growth opportunities. And you can grow at 30-40% on this book for the next 3-4 years. You've got a few hundred crores of tax shields because of your carry forward losses. You're fully capitalized. You're not messing up on the asset quality front. Fat spreads, wholesale rates coming down, and a market where you are clearly the number 2 or number 3 player, where except I think barring the top 2 players or something, Bandhan and them, Bandhan is not listed, but I would be looking forward to their listing at some point of time. So barring them and Bandhan, I don't see any large sensible player having a pan-India reach, and it's a market which is maybe about 20-30% penetrated. So there you are. You look at a federal bank which is consciously cut down on its corporate loan growth in the face of difficult times and a little bit of a lack of, grip on their corporate book, and they are coming back magnificently. And they are fully capitalized. They've got OPLEV waiting to play out. You look at DCB, which has actually managed to grow at 20-25% in bad times with a very tight fix on asset quality and increasing granularity on their balance sheet. So, I mean, why would I go to look at the large and established names when there are so many talented people in the mid-caps doing a good job and very well poised for this new India now?
Oh, absolutely. And actually, I want to get one of those names which we don't normally speak about, and now I'm coming to more consumer discretionaries, maybe. Siaram Silk Mills. I've never heard anyone mention that.
So they make textiles, and it doesn't get less glamorous than this, right? Polyviscose fabrics. But they are putting in a couple of premium ranges of cotton and linen and so on. It's India's largest player in branded textiles in the mid-income or mid-spend segment. And polyviscose is a fabric of the masses. I'm of course excited at what is happening at Grasim, but that's a different story on viscose. That's more on the commodity or fiber side of the game. On CRM, what impresses us is that they are approaching the end of a capex cycle. So now the business is going to generate free cash flows meaningfully. It's already working at 20% kind of ROEs, and it's trading at some 7x F16. Except for the fact that they are in textiles, which nobody seems to like. The fact is that over the next 2 or 3 years, there's going to be an incredible personal income upgrade, which is going to play out in common man India, as it were. And I don't see their margins coming off. I don't see their growth under any challenge, and I don't see cash flows getting back into capex. So that tells me that at 7x, the stock was actually at $400 not too long ago.
So let's just try and squeeze in some more questions before we run out of time.
Yes.
Specialty restaurants. I mean, there is a subdued demand environment, but you would still buy that stock?
So yet another example of a company which we don't cover formally, and yet went out on a limb and said, listen, this is worth buying. Now they have a fantastic fine dining franchise. The naysayers are arguing that they are neither the 5-star bracket nor are they the QSR, and that they have a capital intensive model which prevents them from making very large free cash flows. But heck, margins are at a 4-year low. They've been battling food inflation for 3 years. That is coming off. Discretionary consumption in the metros and large cities is taking off. They've got cash on the books. They don't need to worry about blowing up as a company just because demand has been sluggish for a while and profits are down. I'm not playing the numbers here. I'm playing a theme. I'm playing a story here. And God knows the management is probably the most gifted management in terms of fine dining, branding, and the quality of food. If you've been to any of the mainland Chinas, you'll get lip-smacking food there. So there's no argument on that. I know so many people who have developed a taste for Chinese food just because of mainland China. This is not an ad for them, but what I'm trying to say here is that...
It's okay, Lata is also a big patron of mainland China.
And yes, they're costly. I mean, I think they should be... I would be happy if they'd sell their stuff at half the price and so on, but it's not going to happen. The pricing power is actually going to come back as the queues elongate outside their restaurants. And right now, they're not doing even, half a turn on their seats on a daily basis. So look at the OPLEV hidden there.
Okay. No, point taken. That's an excellent plate of starters that you have put in front of us this morning. Thank you very much, Dipen, for joining us. Have a great weekend. Maybe you can even visit specialty restaurants.